Let's be honest, money can feel like a totally different language, one you were never really taught in school. So today, we're going to change that. We're breaking down some of those big, intimidating financial ideas into simple concepts you can actually understand and use. Let's dive in.
We've all been there, right? You get that first big paycheck. You're so excited. You tear open that envelope or click the email, and then you see the number that actually hit your bank account. And it's way smaller. It's a universal feeling of confusion and, maybe a little bit of heartbreak. So that's the million-dollar question, isn't it? Or in this case, the $544 question. What are these invisible hands taking a cut of your money before you even get to touch it? Figuring this out is really the first step to understanding the entire system.
Okay, so in our first section, we're going to look at the systems that control your money right from the start. All the stuff happening in the background that has a huge impact on your financial life. That biggest chunk that just vanishes? Yeah, that's taxes. The easiest way to think about it is like a subscription fee for living in an organized society. It's the money that pays for roads so you don't drive through potholes, for schools, for firefighters, all the stuff we kind of take for granted. And the government collects this fee in a bunch of different ways. You've got your income tax, which comes right out of your paycheck. There's sales tax, which gets added on when you buy things. If you get into investing and make some money, they'll want a piece of that too. That's capital gains. And then there's Social Security and Medicare, which is basically a mandatory savings plan for your own retirement and future health care. All right, so after the government gets its share, you take what's left and put it in a bank. And most of us have this cartoon image of a bank in our heads, right? Like our money is just sitting in a big vault somewhere. But that's not really how it works at all. Here's the real deal. A bank isn't a storage locker. It's more like a money recycling plant. You deposit your $1,000 and the bank is legally required to keep a tiny bit of it, but then it turns around and lends out the rest, that $900, to someone else who wants to buy a car or, a jet ski. The entire banking system is built on this idea of keeping money moving, and it all works on the bet that we won't all show up at the same time asking for our cash back. Now, hearing that your money is being lent out might sound a little sketchy, right? But don't worry, there's a massive safety net. In the US, the federal government insures your deposits up to $250,000 per person per bank. So even if that jet ski loan goes belly up, your cash is safe. All right, let's move on. Now we're going to talk about some concepts that are like a double-edged sword. Used correctly, they are incredibly powerful tools for building wealth. But if you're not careful, they can become really dangerous traps. Let's talk about interest. This is a big one. When you borrow money, like with a credit card or a loan, interest is the extra fee you pay for that privilege. It's what turns a $12 burrito into a $50 regret a few months later. But, and this is a huge but, when you save or invest, interest works for you. It becomes your best employee, working 24/7 to make more money all by itself. And the amount of interest you pay is often decided by this one little number, your credit score. It's super important to understand this isn't a measure of how rich you are. It's a measure of how reliable you are. Lenders look at it to answer one simple question. If we lend this person money, what are the odds we'll get it back? So what actually goes into this score? Well, as you can see, the biggest piece of the pie, a whopping 35%, is just your payment history. That's it. Paying your bills on time is the single most important thing you can do. It's not rocket science, it's just consistency. I absolutely love this analogy. It's just so perfect. Your credit score really does need your attention. If you just ignore it, it will eventually make a huge mess of your financial plans. But if you take care of it, feed it with on-time payments, it becomes this amazing companion that can help you achieve huge goals, like buying a car or a house. Okay, so we've covered a lot of the personal stuff. Now let's zoom out and look at the bigger economic forces that are swirling around us all the time. Think of this as the financial weather report. You can't control it, but you should probably know if it's about to rain. You know that feeling you grab a bag of your favorite chips, you pop it open, and it's like half air? That is inflation in a nutshell. It's the slow, sneaky way your money loses its power. A $5 bill today is still a $5 bill tomorrow, but you'll start to notice it buys you a little less gas, a few fewer groceries, its value is slowly shrinking. And then you have the flip side of a hot economy, a recession. So if the economy is one big party with lots of spending and jobs, a recession is when the music abruptly stops. The lights come on, people stop spending, and companies start laying people off. It's a painful, but historically, a totally natural part of the economic cycle. All right, for our final section, we're going to switch from playing defense, just protecting your money, to playing offense. How do you use all these systems and concepts to not just survive, but to actually get ahead and build real wealth?
So, we just talked about inflation, that silent money eater that's always chipping away at your savings. How do you fight back? Well, hiding your cash under a mattress is a guaranteed loss. The best offense is investing. It's how you put your money to work so it's not just sitting there losing value. And investing sounds like a complicated word, but the core idea is simple. You're trading your money today for what you hope will be more money in the future. You can do that by buying stocks, which are just tiny slices of ownership in a company, or bonds, where you're basically loaning money to a government or a big corporation. Or you can buy funds, which are just pre-packaged baskets of all those things. The goal is always the same: turn your money into an asset that grows.
But to do any of this successfully, you have to understand this one really abstract idea: value. I mean, why is a shiny yellow rock, gold, worth so much, while a regular rock from your backyard is worthless? There's no magic to it. It's simply because over thousands of years, we as a society have all agreed that gold is valuable. Value is a shared belief. And this is the real secret to earning money. Wealth doesn't just appear. It's created when someone makes something, a product or a service that other people find valuable enough to pay for. Whether it's the brand and quality of a Gucci bag, the specialized skill of a doctor, or the game-changing technology from Steve Jobs, it all comes down to creating perceived value. And if you take only one thing away from all of this, let it be this: building wealth isn't about getting lucky with a hot stock tip. It's not a lottery ticket. The most powerful force in finance is time. Small, consistent actions repeated over decades can lead to incredible results. It's a marathon, not a sprint. So we'll end on this thought. All these forces, especially interest, are at work 24/7, whether you're paying attention or not. The only real choice you have is whether they're going to be working for you or against you. Understanding that difference is everything.